Is prepaying your mortgage a smart move? I'm Eddie Gartner, Epic Financial Strategies. Thank you so much for being here today. And this is what we're going to dig into. Should you prepay your mortgage? Is prepaying the mortgage a good idea? Prepaying your mortgage can seem like a counterintuitive move for young homeowners, especially in an age where financial flexibility often takes precedence. However, this strategy can offer significant long-term benefits, enhancing financial stability and providing substantial interest savings. A few things that you'll want to consider before prepaying your mortgage is actually taking a look at your interest rate. If you're somebody right now that is sitting at a 2.75, maybe 3.5, even a 4% interest rate, do you really want to start prepaying those mortgage dollars? Because over that 30-year term, that interest rate is so low compared to what's in the market today. So do you have the ability to save money outside of the mortgage and be able to gain more in the long term than you would from paying off? But if you're in that 7%, 8%, sometimes people in that 9% interest rate, you may want to take a look at what are the smart things that I can do and what are the strategies that I can use to maybe pay this down quicker to reduce my overall borrowing costs. We're going to go over 5 benefits of prepaying the mortgage today, and that first one being the psychological benefit. Reducing debt early can also relieve psychological stress, providing peace of mind that comes from lower debt levels. For young homeowners, this means enjoying their home more fully without the looming burden of long-term debt. The way that you deal with money is more psychological than anything else. So yes, the idea of paying down that debt may be the #1 priority for you. You could be somebody, though, that is focused on building and growing wealth, so maybe prepaying the debt might not be the best option. Again, this is where we got to look at the numbers, but psychologically, how will you feel about it? Because if you're on a plan that you really are fully bought into, that's going to be the best plan for you, because you're going to follow it, execute it, be able to reach those goals that you want to. Also, when you're looking at long-term home ownership, right? And that's what we really want to think about this for. Do you want to prepay a home that you plan on selling very quickly, right? Some things that you need to think about, because that short-term liquidity may be more helpful than prepaying that debt and getting a bigger check when you sell the house, right? So these are things that you want to think about on that long-term ownership. And this is the house of your dream. You want to stay there forever. Well, maybe cutting that down, that time frame that you need to pay, may make some good sense. Number 2 is lower interest cost. With rising mortgage rates, prepaying your mortgage allows you to capitalize on lower rates by reducing the total interest paid over the life of the loan. Less money spent on interest translates into more savings that can be redirected towards other financial goals, such as investments or retirement savings. Again, this is where it makes sense to really look at the interest that you're paying today and those interest rates. If you have really, really low interest rates, prepaying the mortgage may not be the best option for you, and that's something you really got to take a look at. But with those higher interest rates, sometimes now it does look like if we can cut that mortgage down, you can save a ton of money. And we're going to talk about some examples of how you can do that. So looking at the interest rates today, if you're locked in for a 30-year mortgage with a 3.25% interest rate, does it really make sense in this type of economy to be prepaying? Because in actuality, that could be the lowest interest rate on a debt that you're paying today, especially if you look at what credit card interest rates are or even home equity lines of credit today. If we look at people that maybe got in at a 6, 7, 8% interest rate mortgage, well, then do you want to start prepaying that down because you plan to be in this house for a long, long time? And if that's the case, by making one extra mortgage payment a year, you can cut down the term of that loan from 30 years down between 4 to 7 years. That means that mortgage would be a 26-year to a 23-year mortgage just by making that one extra payment. Number 3 is access to equity. By accelerating mortgage payments, you reduce the principal faster, which not only shortens the term of your loans, but also increases your home equity quicker. This equity can be leveraged in the future for financial needs such as home renovations or as collateral for other loans, giving you more control over your financial resources. Here's the challenge with equity in your home. In order to access that equity, you need to go out to a bank and leverage it in the form of a home equity line of credit. The bank has no obligation to give you access to your equity, which means if you're in a position where maybe you don't have a job, maybe things are tight, you have high debt to income ratios. If that is the case, that bank could say, you know what, you have no access to your equity. Or they could say, yeah, we'll give you a small portion, which may not be what you were looking for. So be careful in that game of, hey, yeah, I'm gonna prepay my mortgage down, but don't necessarily think that the equity is accessible to you. So number 4 is mitigating risk. Life is unpredictable. Prepaying your mortgage can provide safety net by reducing the long-term financial obligations. For young people, this is crucial as it lowers the risk of defaulting on the mortgage payment should unexpected events like job loss or medical emergencies occur. I'm going to disagree with some of that, right? So here's what you have to think about. Again, just like we were talking about before, having equity in the home doesn't guarantee you access to that equity. And just the same, if you're prepaying that mortgage and you're foregoing savings, that could be a recipe for disaster, because if you don't have savings built up and you lose your job, the mortgage payment is still due, right? So it's not that you're going to be able to not pay because you've prepaid all these times. So this is things that you really have to take into account before you start prepaying your mortgage. Have you built up the right amount of emergency savings? And number 5 is the compounding benefits. The earlier in the mortgage term you begin making additional payments, the greater the impact on the interest compounding. This means that even small additional payments can lead to substantial reductions in the total amount of interest paid over the life of the mortgage, freeing up funds sooner for other use or investments. The compounding benefits is what we went back to earlier before talking about making that extra mortgage payment, right? If you're doing that early in the mortgage, you can reduce the term of which you have that mortgage, taking a 30-year mortgage and potentially cutting it to a 23-year mortgage, right? Cutting 7 years off. There's other ways to accomplish this compounding effect. There's strategies using home equity lines of credit or other cash built up that you can pay down in chunks and really knock off big portions of the mortgage, paying it down much more quickly. The way that you do that and the way that you strategize that, you really have to make sure you don't eat into your safety net and that you're doing this with a strategy and a purpose, right? Again, this is a long-term property that you want to stay in forever. If this is a short-term property that you're likely going to sell pretty quickly, the idea of prepaying, I don't think it makes a lot of sense. And this is where it becomes important to consult with an advisor. Young homeowners should consider their personal financial circumstances, such as debt levels, investment opportunities, and financial goals before opting to pay off their mortgage early. Consulting with a financial advisor can provide tailored advice that aligns with their specific needs and future aspirations. And again, this isn't just young homeowners. This is homeowners of any age. They should really be looking at and making these decisions with financial professionals that can stress test these decisions for them. If you've watched this far, thank you so much. And if you enjoyed the content, give it a like. Be sure to subscribe for more videos just like this. And if you're looking to talk to somebody to navigate through your savings, your paying off of debt, and your investments, click in that description box below. One of the team members here at Epic will reach out to you and walk you through our success process. Thank you again for watching. Stay tuned for the next one.